So explain exactly what the market reaction was this week, because the stock market really didn't react too vigorously, although the bond market did to these jobs numbers.
Well, thanks, David. The stock market is likely taking its cue from earnings more than it is any of these potential underlying impetus for changes in interest rates. Likely most investors recognize that the Fed is in a difficult position and lowering rates might be tough with this sort of strong data. On the other hand, earnings coming out of some of the market leaders still looks really good. And that's probably what's keeping the market afloat.
So I wonder about this question of interest rates. There's a lot of speculation about what's going to happen this year for the Fed. We went into the year with six rate cuts baked in. We're way off of that now at this point. But what about for the longer term? Are we getting a sense maybe the longer term interest rates, some people call it the neutral rate, will be higher? And if so, what does that mean for you as an equity investor?
Well, if you care about valuation, you have to use tools like discount rates. In other words, a stock is just worth the present value of all the cash it can generate into perpetuity, discounted to present. And the higher that discount rate goes, the less the cash flow stream is worth. Or think of it another way, the valuation multiples need to come down. So prolonged higher rates is a kind of a sobering effect for markets and investors. We have to be very careful about what we pay. And it also makes fixed income a very viable alternative to equities. So there's competition out there. So higher rates, if they're sustained, also have economic impacts that we have to take into account when we do valuation work. So there are all myriad of reasons why sustained higher rates can lead to a tougher environment for stocks, not just because companies' earnings may be under pressure, but also because investors might want to go elsewhere.
Over any reasonable period of time, the stock market has done pretty well. Take the S&P 500, for example. But there are a few stocks that have really driven it disproportionately. Some of those big tech stocks, the AI stocks. Can that keep going?
They could. It's very hard to call the tops of any of these stocks that have so much momentum behind them and have sold their product, like NVIDIA, far out into the future. They look so certain. And yet, as the price rises, it gets closer to something that approximates fair value. And we're not seeing the big earnings upgrades any longer. The pace of that has slowed. So it's very likely that these big market leaders, at least for the time being, the next 12 months, have seen the bulk of their returns. Now the question is, what's the next set of stocks that will benefit from the same theme that propelled these big market leaders? And if it's not GPU, if it's not the chips and it's not the servers or the data centers, then what? And there are some fascinating, great stocks in that layer beneath who should benefit from, for example, the demand for much more memory. So that's DRAM memory, not just the high bandwidth memory that an SK Micron has and Samsung Electronics soon will have, and Micron in the US, but even the commodity memory will be more in demand because there's only so much factory floor space. There's almost only so much room to make these high bandwidth memory chips. They're faster. They're less power consumptive. So memory is so interesting, and stocks like Samsung trade at very reasonable multiples.
What about some of the stocks that have actually taken something of a hit, particularly in the information tech services area, on the assumption that perhaps generative AI will really hurt their business? Is it possible the market's overreacted with some of those?
Oh, those stocks had a terrible time when cloud was first transitioning, because enterprises say, oh, we can do it ourselves, and they very much can't. First of all, for most companies, they need to build the infrastructure to adopt AI tools. So infrastructure comes first and then applications second. And you can look across almost all IT services companies and find that the market is very negative on them, but they have good base businesses, and without doubt, and this is companies like Cognizant, for example, in the US, or Fujitsu in Japan, the orders will have to pick up because enterprises were going to need help. Enterprises will have to work with their IT services companies in ways they've never done before in order to implement AI.
So take us beyond U.S. borders, if you would, for a moment. The U.S. stocks have been the place to go. U.S. has been, in general, the place to go for investment. Does there come a point where actually there's some interesting possibilities overseas?
Well, overseas markets in general trade at massive discounts to the U.S. And as we've told our clients, that discount doesn't need to close entirely. It's at a 2 standard deviation high versus the 10-year average. It just needs to close a little bit. And we think it's very likely that as the U.S. market cools off with the sustained higher rates environment, rates are coming down outside the U.S., that we'll see some improvement in multiples offshore. But because the gap is so wide, it's historically wide in valuation terms, that makes non-U.S. less risky in a way. It has less to give up than does the U.S. market. And that's one of the reasons why or let's just say our finding so many stocks outside the U.S. validates this top-down view.
How much was Japan? You mentioned Fujitsu earlier.
Well, the Japanese market was discovered a year ago and has been bid up feverishly. But it's a big market, and there's still companies there that the market has yet to embrace, not just IT services, but in automation, for example.